We already discussed here that the oldest goods are sold first and the newest goods are kept in the inventory, which means when prices are rising, the expensive goods will remain in the inventory while the cheaper ones will be sold first. So therefore the cost of the items in the inventory will be higher than the ones which are sold. So let's say this is your inventory. This is the cheaper one, the first bought or purchased or produced ones, and then this is the later ones. So if you are going to do first in first out, you will sell these ones first, right? These will be the ones that will be sold first, and these will be the ones kept in the inventory. So now you've sold those earlier ones, and what you have in the inventory is 2 units of $2 each, which is obviously $4. And then finally, when you sell those two as well, then your inventory will go to zero, assuming you're not buying anything new. So what is the advantage of FIFO? And why does IFRS not allow LIFO? So this is something that will be discussed in more detail when we get to LIFO and LIFO reserve. But since we are already discussing this point, that an advantage of FIFO is that it is subject to less manipulation. So let me explain a little bit over here as well. See, if you have this $1 cost and $1 cost, and then the $2 cost, and then the $2 cost, if you do LIFO, which means you sell the expensive inventory first, which means you keep the cheaper inventory on your books, and let's say this is sold, right? And whatever is your selling price, let's say your selling price is 3. Now, instead of buying new inventory at whatever is the new price, let's say it's 2.5 or 3 or whatever, instead of buying new inventory, what you could do is you could sell the old inventory and have a bumper profit, right? Which is going to be 3 minus 1, which is a huge profit margin. So what happens with LIFO is that because they're keeping the cheaper inventory on their books, at any given point in time, what they can do is they can stop the purchasing of new inventory, right? Which is obviously going to be coming in at higher prices because the cost has gone up, the price has gone up. In inflationary environment, it's a environment of rising prices. So instead of buying at the new costs, because if they buy the new cost under LIFO, they will have to sell that one first. So they stop buying and they start selling the cheaper inventory, and they show these bumper profits. So whenever they need to boost their earnings, whenever they need to show higher profits, they can manipulate the earnings if they are doing LIFO. And that is why IFRS does not allow LIFO, because it leaves this room for manipulation open. In FIFO, you cannot do that because you're selling the first in out first. So whatever was bought, it's already history. You cannot manipulate that. Right, weighted average is very simple. You just take all the cost of the inventory and you divide it by the number of units you have, and you get cost per unit, right? So here you have total of $6 in inventory, let's say 4 units, so $1.5 will be the cost of each. And then if you sell 2 units in the first period, so that's just going to be 1.5 into 2, which is $3. And then the remaining inventory will be 1.5 per unit and 2 units remaining because you sold 2 and you have a total of 4. So you sold 2, now you have 2 left, and then when you sell those 2 in the second period, then the cost of goods sold will be equal to 3, and then finally you have 0 left because you have not bought any more. Right, and now finally to the last in first out. Here the newest ones are sold first, the older ones remain in the inventory, and obviously if it's a rising prices environment, then the older ones will be cheaper and the inventory value will be lesser. So the inventory value reflects the cost of the older goods, right? And if they were the cheaper ones, then inventory will be showing a low value. Here we are assuming we sold the $2 expensive inventory first, and what you have left on the books is the cheaper $1 one. So you sold the $2 two pieces, so 2 into 2 is 4, right? You sold that, and what you have left is this $1 each, so two pieces of $1 each. And then when you sell that, so that is sold, and then your inventory goes to 0. So LIFO is not allowed under IFRS. Why? Because it leaves room open for manipulation, because you've got this low cost inventory on your books, and at any given point in time what you can do is you can just stop buying new goods, right? And you can sell the old cheaper ones and have a bumper profit. So you can increase your earnings when you want. And in times of rising prices, so even though you have inventory of $1 on your books, and let's say first you sell the $2 one, then you sell the $2 one, and this is sold, and then cost has gone up even more. You're buying at 2.5, you're selling at 3, so you're selling out this 2.5 first, which means lower profit, right? Which means lower tax. So that also helps, because you save tax, you save the cash going out on tax, even though eventually you will have to sell this cheaper inventory. So the profit will come later, but for the time being it's not coming. So you're saving the cash flow, right? So you get positive cash flow, because for the time being what you do is you declare a lower profit and you pay a lower tax on it. Eventually, of course, when you need it, when you need to boost your earnings, you can stop purchasing. You can stop purchasing and sell out the old cheaper inventory, which means you will have huge profits, right? If you're selling at 3 and the cost is 1 on your books, you're going to have huge profits. But obviously that will only be done when you really need to boost your profits. If you're having a bad year overall, then you might stop buying new inventory and liquidate the old inventory. This, by the way, is known as something called LIFO liquidation, and we will talk about that in more detail shortly. This is called LIFO liquidation, but we will talk about that in more detail shortly. Let me first take you through the rest of the summary for all these three inventory methods, inventory valuation methods, because what happens is that the impact on cost of goods sold and the value of the inventory on the balance sheet is going to be different for each of these methods in times of changing prices, right? And from an exam perspective, what you need to do is you need to remember what is the impact. So I'm just going to show you from the example that we just discussed with the $1 and with the $1 and then the $2 and then the $2 inventory. What was happening in first in first out is that we were selling the cheaper one first, right? And since you were selling the cheaper one first, your cost of goods sold was lower. In last in first out, we were selling the more expensive one first. That's why our cost of goods sold was higher. And in weighted average, it's the average of the two. Now, if your cost of goods sold is low, naturally your gross profit is going to be high. Whereas if your cost of goods sold is high, your gross profit is going to be low, right? So this is quite easy to understand, but it's important for you to remember that in times of rising prices, your LIFO, cost of goods sold, is high and your profit is going to be low. The reason for that is you're selling the expensive one first. And since you're selling the expensive one first, you're leaving the cheaper one in your inventory. Therefore, the value of your inventory is going to be lower compared to that in the case of FIFO. Right? However, if you stop buying and you sell the old inventory, then what happens in period 2? See, this is important to see as well. Now, what's happening in period 2 with the LIFO company is that now you're selling the cheaper inventory, so your cost of goods sold is low and your profit is high. Right? This is what we call LIFO liquidation. This is only going to happen if you are stopping your purchase of new inventory, which is what you see in this example, right? If they were buying new inventory, let's say at 2.5 or 3, then their cost of goods sold would have been much higher. 2.5 into 2 would have been 5, right? But that's not happening. They're selling the old one, and that's why you're seeing that LIFO liquidation is happening. So what are the points to be noted over here? Number one, cost of goods sold and gross profit is same under each of these methods. Let me just go back and show you, and let's total the profit, right? Let's total the profit. So gross profit 8 plus gross profit 6 and gross profit 6 plus gross profit 8. which is, of course, this 8 plus 6 is equal to 14, 6 plus 8 is equal to 14, and 7 plus 7 is also equal to 14. Now, eventually, they're all declaring the same amount of profit. The reason for that is that we are not purchasing any more inventory. We are stopping the purchase. So whether you sell this one first and then this one later, or you sell this one first and then this one later, it's not going to make a difference because you've stopped the purchase of new one. But it really makes a difference if you don't stop the purchase and the prices keep rising, and in LIFO you keep selling the expensive one first and you keep the cheaper ones on your books, whereas in FIFO you keep selling the cheaper ones first and you keep the expensive one on your books. Over time it really develops to a huge difference, right? And that is what we will talk about when we get to the LIFO reserve. But before we get into LIFO reserve, I really want you to memorize this table. And what is being discussed over here is that when prices are rising with LIFO, you are going to be selling the expensive inventory first, which means your cost of goods sold is going to be higher, and in first in first out it will be lower. And since you're selling the expensive inventory first in LIFO, therefore your profit will be low and your taxes will be lower. Your profit will be lower, your taxes will be lower, so net income, earnings before interest, tax, everything will be lower. Even your ending inventory will be lower because you're selling the expensive inventory first. You're keeping the cheaper one on the books, right? Your working capital, which is your current assets minus current liabilities, will be lower as well because cheaper inventory on the books means lower value of current assets. However, your cash flow is going to be higher. So this is very good, right? So if I was a US based company and I was allowed to follow LIFO, because IFRS doesn't allow LIFO, but US GAAP does, so I would go for LIFO. The reason is I save the cash flow in tax, because lower profit means lower tax. And even though eventually if I stop purchasing and I sell my cheaper inventory and I declare bumper profits, then I might have to pay higher tax eventually, but it will be a much later date when you have to do that. And all those years I will save the cash flow, number one. Number two, I will also have that option of liquidating my LIFO reserve whenever I want, right? I've got this sort of reserve. Whenever I need, I can boost my profits. So that's a very important concept with LIFO, and we'll talk a little more about that just very shortly. But before we do that, of course, weighted average is going to be in the middle of LIFO and FIFO, right? So how do you remember all these points? First of all, you can just take that simple example of $1, $1, and then $2 and $2, and always think about it whenever you're given a question, right? So if they ask about cost of goods sold, the expensive ones will be sold first, so definitely immediately you can think in your mind that okay, the cost is going to be higher in LIFO because the expensive one is being sold first, and therefore the income will be lower, and the cheaper inventory is left on the book, so ending inventory will be lower as well. And therefore, because the profit is low, the cash flow will be saved because tax will be lower in LIFO as prices are going up. And therefore, companies that are following US GAAP will prefer LIFO because taxes are lower, and of course you have the benefit of LIFO reserve, which we'll just talk about shortly. Now, before we get into the discussion about LIFO reserve, in terms of earnings quality, so this is not related to the quality of your product or service, this is related to the quality of your financial statements. And as an analyst, what we like to see is good quality financial statements. So when a company is doing LIFO, is that better quality? Or when a company is doing FIFO, is that better quality of financial reporting? Now, both are good, but depends on what statement you are talking about. So if you're talking about the income statement, LIFO gives a better income statement. Why? Because last in first out means the cost of goods sold, which is being shown on the income statement, is the latest cost of goods sold, is the latest goods that you're buying. So it's the most recent cost. So that's why income statement is better earnings quality on reporting quality, better financial reporting quality for as far as income statement is concerned, but for balance sheet, because in LIFO you're leaving the old cheap inventory on your balance sheet, so that's not giving a very true accurate picture. Whereas FIFO, which is selling the first ones out first and leaving the latest one on the balance sheet, so the inventory value that is showing on the balance sheet is more accurate and reflecting better quality information. So as far as earnings quality is concerned, balance sheet is better in FIFO, and earnings and income statement is better in LIFO. Now we come to the much awaited LIFO reserve. Now see, if you are keeping the cheaper inventory on your books, if you're doing LIFO and selling the more expensive ones first, compared to if you're doing FIFO and you're selling the earlier ones first and keeping the latest ones on the books. So let me repeat again. 1, 1, 2, 2. And if you're doing LIFO, you're selling the expensive ones first, keeping the cheaper ones on the books. Whereas if you're doing FIFO, you're selling the cheaper ones first and keeping the expensive ones on the books, which means that in FIFO, the value of your inventory will be more, because 2 plus 2 is obviously 4, right? And 1 plus 1 is 2. So naturally, your inventory is going to have a lower value in LIFO. So this difference that you have between these two, this is what we call the LIFO reserve. And what does that mean? See, the selling price of the business is probably going to be the same. So let's say you have Pepsi and Coke both selling at $3 a bottle, but one has sold the expensive pieces first and keeping the cheaper inventory on the books, and the other one has sold the cheaper units first and keeping the expensive inventory on the books. So now they both have the same selling price. If they stop buying new units, obviously the one with the LIFO is going to be declaring higher profits, right? So 3 minus 1, or let's say if they sell 2 units, it's going to be 3 into 2 is 6. So they'll get a revenue of 6, but their cost is only 2, whereas they will get a revenue of 6, but their cost is 4. So they will both declare different profits. The party with the LIFO is going to declare a higher profit because they've got that reserve which they can liquidate. So this is the concept of LIFO reserve, right? And how is it calculated? It's very simple, that the value of the FIFO inventory value minus the value of the LIFO inventory value, that difference is called the LIFO reserve. And how can you get into LIFO liquidation? So all you have to do is basically you stop buying new inventory. So the number of units being sold, right, if that is